Welcome to another video by Netpicks, and on this topic here, I just want to say that a lot of people, they make trading a lot harder and more complicated than it really needs to be. And I think that's a huge problem. And that's the issue that we're going to discuss in this video. So first, let's get started by giving you the chance to download this free guide to trading common price patterns. And a lot of people that have grabbed this have written in to say how impressed they were with it. So you can grab it in the link above or below in the description. Now let's get to the topic. Now, fundamentally, trading is a simple game, but it requires a great deal of thought, a great deal of effort, and persistence to succeed. In poker, the saying from Poker Hall of Fame member Mike Sexton, it goes that it takes 5 minutes to learn and a lifetime to master. And I think trading is similar in a lot of respects. And yet, if it's approached in the right way, competence can be achieved a lot more quickly, I think, than a lot of people realize. And there's nothing complicated. There is no magic formula. There's no holy grail, and there's no silver bullet. It's just really simple, well thought out, and carefully ordered common sense. And you're going to find that these 6 keys to trading success we're going to talk about, they appear simple, and I think you're going to be amazed at how important they are for you to reach your trading goals. And the first one we're going to talk about is technique and market knowledge. And this is the one that a lot of new traders spend a lot of their time on. And yet it really only equates to a small portion of trading success. Yes, it's very important to have a good knowledge of the various sides of the market you're trading, and your trading strategy, and the products you trade. So you really want to get a good understanding of how these things work, but understand they're just a small part of the success pie. And preparation, that's the second one. And preparation for the trading day comes in 2 parts, rather than just the obvious one. Now, looking for what you might expect to see from the market, if there are any key releases that day and so on. We want to see if there's anything that's going to come out in the market that can surprise us. You want it to be a routine and an almost ritualistic mental rehearsal, and that goes into standard preparation. So don't rush, and make sure to get yourself in the right frame of mind before you start trading each single day. Risk and mental approach. Risk is what we as traders live and die by. If you don't risk anything, you're not going to make money. But if you don't control your risk, then you're going to find your trading account running dry faster than you think. And knowing that part of trading is losing on any one trade or a string of trades, that is vital for you to understand. You select your trades, and then you risk X amount of dollars. You control your risk on each trade to give yourself a fighting chance of success in the long run. And you have to be able to accept that. Now, trade selection and execution. And if you're a discretionary trader, you're going to realize that when it comes to taking a trade, there's just a little more to it than just clicking the buy or sell at a certain price or a trading setup. Some seemingly good trades that you take, and you know you shouldn't have, and they lose money. Then there are trades which you pass on. You end up kicking yourself when they make money because you had no real reason to not trade them. To increase your chances of selecting good trades, it's really important for you to have a methodology which incorporates criteria for selecting your trades and which ones you're going to pass on. Otherwise, it's more than possible that you're going to be deciding based on your fear or your greed at that moment. Trade management. And this is one where a lot of traders just overlook it. If you focus all of your efforts on getting that perfect entry, you can miss the point that it doesn't matter how great an entry is unless you can hold that position and make that register ring. So if you don't have a method for holding your position or exiting your position, you're going to find it a lot more difficult to maximize a positive trade or just take a profit when you should be. Now, just as controlling your risk is important, making the most of your winners can make a huge difference to your bottom line and your equity curve. And that's one reason that I use a trailing stop in my trading approach. Maintaining performance. This is a big one. Hitting that trading sweet spot on any one day, any week or a month, it's great. And even though we'd love to do it all the time, it's not going to last forever. So when you trade, you have to expect to go through good patches and bad patches. It's just, that's how trading is. But what you can do is ensure that you're in the best possible place to trade mentally, physically, and emotionally. And we all know the things which help us, and we all know the things that don't help us. So we just do what we have to. No excuses. Write them down if you have to, and make them part of your trading plan. Now, these keys are written in a broad sense, but that's because I think they apply to every single trader out there that's listening. Your job is to flesh out these ideas fully for yourself, for your own trading, for your own approach, and then create a clear trading plan or directive that includes all of those. Thanks for watching. Hit subscribe button.